Hi everyone, welcome back to the audit and attestation class. In this class of assessing the risk and developing the planned response to those assessed risks, we'll be covering the topic specific area of engagement risk, and the subtopic we'll be covering in this session would be compliance with law and regulation, including possible illegal acts. Second, accounting estimate including fair value estimate, and the last one is the related party and related party transaction. So let's dive into for more detail.
So we are done with internal audit work and their involvement, right? So we are jumping into the last topic of chapter 2, which is specific area of engagement, right? In this we'll be learning 6 things. First one is compliance with law and regulation, including possible legal acts. Second is accounting estimates, including fair value estimate. Third is related party and related party transaction. Fourth is significant recent economic and accounting and other developments. Fifth is improper revenue recognition, and last one is non-routine and complex transaction. So this I put over here in a tabular format. So you can go one by one. First, look at the compliance with law and regulation, including possible illegal acts. So here, as an auditor, as a CPA, we need to keep in mind what all requirement of the laws. Like for example, there's a requirement of Medicare tax, city tax, state tax, right, federal tax, right? So you might have requirement of value-added tax, right? You might have requirement of payroll taxes. You might have requirement for like special reportings for different tax purposes, right? Those all things, whether the company is in compliance or not. If the company is not in compliance with the regulatory requirement, then there would be a risk. There would be a risk of litigations, claims, assessment from those respective authority, and that may result into a going concern issue as well. So that is the reason these couple of points are basically the generally you can say key consideration or risk areas in an audit engagement, and auditor as a CPA we need to give more focus and consideration to it. So first one is the compliance with law regulation, including possible illegal act. So first is risk and risk factor indicator. What do you need to keep in mind? First one is many law and regulation may or may not directly impacting financial statement. For example, the company may have environmental law, like for example, it's a manufacturing company. So they may have like environmental law applicable to them, right? They need to do the compliance with those environmental law. That means the pollution from their manufacturing setup should be within certain limits. Beyond that, if it goes, then there would be a huge penalty from the environmental authority, right? Same way like safety law, hazardous component law, right? Those all things the company need to maintain their respective norms, even though they are not directly impacting and reporting into the financial statement, but non-compliance of that may result into shutdown of your operation as well, right? Makes sense? So as an auditor, we need to look at the compliance of those as well. Second is non-compliance may involve conduct designed to conceal it, such as collusion, forgery, or intentional misrepresentation. So non-compliance, there might be a reason of non-compliance, maybe for any fraudulent activity, maybe for any intentional misrepresentation, or maybe any collusion between the two employees. So that also you need to check. Or third is litigation matter, which you need to look at from, like generally we take like third party confirmation or a lawyer confirmation. So these are like areas which you can consider as a risk factor or risk indicator. So if these things exist, that may represent that there might be a risk around the compliance or regulatory matter. Then what are audit procedure you should be planning to mitigate those risks? First is the inquiry with the management and those charged with governance about the compliance with law and regulation, whether the management maintain any tracker or management do have any internal reporting process for all the compliance with the respective laws and regulation. right? For the manufacturing company, there are so many different law like environmental law, safety law, insurance law, right? All those things are applicable. So does the management have internal reporting requirement to ensure the timely compliance of those regulatory requirements, right? So first you need to inquire those things with the management and those charged with governance, right? Now we are at, first we have discussed like risk indicator. Now we are coming to the audit procedure which we need to perform. First is inquiry. Second is inspecting the correspondence with the relevant licensing or regulatory authority, like what all communication they are making to those respective authorities, right? For example, are they making timely submission of the compliance reports or compliance checklists? Like for example, for VAT, are they doing monthly submission of the VAT payable? Are they doing quarterly filing of the VAT, right? Or for example, environmental law, if they need to take certain license, right? Are they taking those license timely or not? Those things you need to inspect. Inspection means like vouching and verification of those respective documents to ensure they are compliance with the regulatory requirement. Third is obtaining an understanding of the nature and circumstances of non-compliance or suspected non-compliance. So here, when you are doing the inquiry with the management, so we'll do the inquiry with the management that whether they are aware of any suspected non-compliance or any non-compliance. If yes, then understand what is it and why it is. Fourth is evaluate the possible effect on the financial statement of the non-compliance. If there is any non-compliance or suspected non-compliance, how much it may impact to the financial statement, that you need to evaluate, and then consult with the management a level above those who are involved in non-compliance. For example, production manager is being involved in the non-compliance of the environment law or safety law, right? Then you will be discussing with the finance controller or finance director, right? Whether he or she is being aware of such non-compliance or not. If he or she is aware of non-compliance, then what is their stand, right? So we'll be discussing with that with the internal management, one level above of those people who are involved in the non-compliance. Consult with legal counsel or specialist, right? For example, if the matter is bigger or material to the financial statement, then involve the lawyers or valuers or specialists of those area. Consult with them, take a formal consultation with them, right? Examine the supporting document, right? And then lastly, third party confirmation. If like management has involved any lawyer in dealing with that cases, take the confirmation from that. Verify the proper authorization of the transaction which has been accounted for around that. Consider any other similar transaction if they have. Discuss with the management and evaluate the impact to take appropriate action. Consider the legal advice. So these all are audit procedures you'll be planning and performing around those area which may result into any non-compliance with any law or regulation. So far, so good.
Yes, sir.
Next is examples. For example, any unauthorized transaction, investigation by the government agencies, enforcement of proceeding, or payment of unusual fine or penalty. Like nowadays, I'm sure you might have heard about ED. Have you heard about ED?
Yes, sir. Everybody has been under scanner of ED.
Yeah. So what they do? They enforce search and seize procedure, right? Same as the authority has been given to the income tax department, in US to the IRS department. So if IRS department has enforced any investigation or proceeding against your client, right, then it will give you like indicator that yes, there's something went wrong. Violation of law or regulation cited in the report of the examination by regulatory agency, large payment for unspecified party or lawyer fees, right, or Unspecified party means they have given some bribery, right? Excessive sales commission or agent fees they have paid, which is not in the normal routine. For example, in real estate, we know like 1% is a normal commission rate. Same way for broker and dealers, we have like standard market commission rates. But if someone is paying more than that, maybe for some licensing expenses, maybe for some bribery, so understand those areas. Unusual cash payments, unexplained cash payment, failure to file a tax return, adverse media comment, significant purchases or sales above or below the market price, right? So these are certain examples which can help you identify, yes, there might be some risk involved, right? Opinion consideration. So when you are look at all these things which is matter relating to non-compliance with any law or regulation, then how it will be impacting to your opinion. Issue a qualified or adverse opinion when there is a gap issue. So when you issue qualified or adverse opinion, when there is a gap issue. When there is a GAAS issue, what kind of report you issue? What type of opinion you issue for GAAS issue? Do you remember that? The chart we have discussed in very first class along with the definition. What are the issues in an audit? Gap issue and?
So gap issue and GAAS issue.
Yes. What if there is a GAAS issue, then what type of opinion or what type of audit report you'll be issuing?
We qualify and a limited, I think, and that we give limitation. Scope
Sir,
limitation.
if the possessive impact of GAAS is,
So I think scope limitation or
Sorry?
disclaimer.
Yeah.
Disclaimer or scope limitation.
Yeah, scope limitation or disclaimer. Yeah, disclaimer of opinion, right? If there is a
Disclaimer.
gap issue, then qualified or adverse opinion. But if there is a GAAS issue, then qualified or disclaimer of opinion.
Then we can withdraw the engagement.
No, withdrawal is the next thing.
Yes.
If determined material effect has not been properly accounted for and disclosed in the financial statement, then you can qualify the issue report. Or qualified or disclaimer of opinion if auditor is precluded. That means you are not allowed by the client from obtaining sufficient and appropriate audit evidence. That means if there is a GAAS issue, then you'll be issuing a qualified or disclaimer of opinion. Third is withdraw from engagement if client refuse to accept the modified opinion and indicate the reason of withdrawal to those charged with governance, right? Fourth one is auditor should determine if he or she have responsibility to report non-compliance to the party outside the entity. For example, if you're doing single audit as well, in that case, you need to report to the respective cognizant agencies that whether the company is in non-compliance with any law or regulation or not. So in that case of scenario, you need to report to the third party as well. So that is something your responsibility. Lastly, audit documentation. Work not documented, work not done. Right? So you need to have sufficient and appropriate documentation. So this is about compliance, non-compliance of any law and regulation. Right? First point. Second is accounting estimate, including fair value estimate. What is accounting estimates? What is accounting estimate?
There are areas wherein management judgment is required,
Yeah,
such as provisions,
provision for
useful
doubtful
life,
debt, provision for obsolete inventory, provision for long-term benefits, warranty provisions, right? Second point over here, it says fair value estimate. What is fair value estimate? Any idea?
So fair value would be a value which would be recognized as if two parties would have transacted independently. What is the value they would have done that transaction for? That
is called arm's length.
Okay.
What is fair value?
Fair value would be the market value, I suppose. Like,
Yeah.
basically, yes. That should, yes.
Yeah. More or less like market value, recoverable value, or in which like you are expecting to recover the respective amounts, right?
Right.
So here, look at the second one. Risk relating to the significant judgment matter arising from. So first you need to identify the risk. Like we discussed, accounting estimates. Accounting estimates are those area where management judgment is being, right? As the management judgment is being involved, you need to understand and assess the risk of those significant judgmental matters or judgmental area. Different differing interpretation of accounting principle. So there might be a possibility as a CPA, you might be interpreting accounting principle differently, and the management might be interpreting the accounting principle differently, right? For example, like one CPA and another CPA, like you guys are doing audit, and general guidance has given that materiality can be in a range of 5 to 10% of profit before tax. So Kush can take 5%, Ayush can take 7%, Jaspreet can take 8%, Kashish can take 10%. That's completely on your professional judgment, right? I can interpret it differently, and Jaspreet can interpret it differently, Kush can interpret it differently, right? There might be a possible area where interpretation is not given clearly in the accounting principle, right? Clarification is not given clearly in the accounting standard codification. So in that case of scenario, there might be a possibility of difference of interpretation of accounting principle. So that may be the area of the risk where significant judgment is being involved. Second is complex or subjective judgment. Complex or subjective judgment, like for example, actuarial valuation. Uh, have any of you have seen any actuarial report?
I have seen.
What all things you have seen in actuarial report?
So, there was
Mortality rate assumption.
average age of employees, well, and there was fair valuation of this gratuity and PF and all these things, short-term benefits mostly. And
Inflation rate, retail and consumer price index.
retirement age is there of the employees as well. And yes, I've seen all these things. I don't remember clearly now.
Yeah. So they have two kind of information. One is financial information. Second is non-financial information. Financial information, you will see the salary details. You will see the increment details. You will see their expected bonus, right? And then inflation rate, like you said, right? Non-financial information is like mortality rate, right? Number of employees, head count, date of joining, right? Or if some people have retired during the year or exited during the year, date of retirement or date of exit, right?
Calculation method.
Their
Black-Scholes
ages,
model.
their ages, right? What is their date of birth to current age, and what is their remaining age, right? How many year of number of year they have given the services, right? And then they apply the Black-Scholes model, like which you are saying, Sachin. In that, they will put both financial and non-financial assumptions and information. Based on that, they do all the mathematical calculation and come up with the value. This should be the provision, or this should be the estimated liability which you need to account for, right? So in that case of scenario, all this transaction, all these information and assumption are generally like complex and subjective in nature. Same way, have you heard about goodwill calculation? When you are doing any acquisition or when you are doing any merger, and out of those merger or out of that acquisition, there is some goodwill arise. So how do you calculate that goodwill or on acquisition or merger? That's also a complex accounting matter, right? Makes sense? And it also involves judgment. So those are the areas, or you can say indicator, where like judgment and risk is high, you can consider. An assumption about the effect of the future event. Have you seen the business plans, 5-year business plans of any entity?
Yes.
when there is any acquisition going on, merger going on, or maybe fundraising activity going on. Have you seen any such projected financial statement?
Yes, in which they mention the KPIs and that they want to how to increase. What are their plans? Like for startups, they basically want to increase the market share, and in public listing company, they want to increase the revenue. So different, and the calculation varies, like how they are calculating those things. But yeah.
Like for example, I'll show you one business plan I recently made. Come here. Right. So see, like this is a business plan for like a startup. So this kind of like for example, like in this, if you see, so this is revenue model, right? So this would be like subscription revenue month on month for next 5 years for an technology based company, right? This is like we are expecting to have ad revenue. There are certain assumptions, like for example, we'll be starting ad after 6 months from 7 months, and we are expecting like 2 vendors to be there, and 25% of that would be their target audience, and this will be the rate, and this will be the calculation, this will be the revenue from ad impression. Then there would be lead generation revenue. So there are certain assumptions over here. If you see, like 10% of certain, 5% of this, and this is like number of advertisers. So these all are assumption based. But this, if you see like 5-year plans based on certain assumption, like this will be the revenue. Same way like the engagement revenue, course revenue, e-commerce revenue. This is like a business plan we have made for an organization. This is a 5-year business plan for a startup. But what all things are here? These all are assumptions, right? This is what all our expectation that this we will achieve this much in over the period of 5 years. Same way like we calculated the revenues, we calculated the HR, like how many number of headcount would be there, what would be the salary, what would be their increment. If you see like total salary of this much amount, number of people, 1 people, then 9, then 13, 19, 30, so on and so forth. As the company grow, number of headcount will also increase, and number of and their salary cost will also increase, right? And same way like the OPEX, for example, like here if you see like budget for expense, like for salary it is coming from their travel expenditure, staff welfare, incentives, consultation. These all in the people count, like infrastructure, rent expenditure, electricity expenditure, and other administrative expenditure, operational cost, marketing cost, sales cost, right? So this is like total expense period over period for next 5 years, right? And then if you see like capex budget, how much is the capex investment required for computer, IT, so on and so forth, right? Then if you see like 5 years cash flow, if you see like how much is coming in from the revenue and how much is going out in OPEX and CAPEX, and what is like net cash flow, right? If you see like this shows in 5 years, the company will be reaching to around 5,000 CR, right? And this would be the P&L. So this is what is it? This is like projected financial statement based on all assumptions, right? There's no actualization. This is what kind of projection generally when any investor make an investment, right? They look at these financial projection and competency of the team who can achieve those projections.
So then we will disclose our key assumptions as well, na, in the financial statement.
Yes. If you see like first tab is the key assumptions. So we are expecting like these many schools will be acquired, these many things will be done. So these all are key assumptions for the respective revenues, incomes, HR, OPEX, CAPEX, cash flow, and
Okay.
right? So those assumptions are very judgmental, right? It's just a thought of your mind. Like for example, like we have started our business. Initially, we also had such a big plan, but actualization, we all know where we are, right? Same way, when you do any acquisition of existing company, they will show you all big pictures. But when actually you acquire, then you get to know the reality, right? In most of the time, like for example, like Byju's has acquired Akash, right? They have paid such a huge amount of goodwill in this Akash or FitG acquisition, right? But now they are struggling, right? For bringing that ROI they were expected from these big acquisition. Right. So all those things are basically like assumptions based numbers and judgments. So when you are evaluating such an acquisition, merger, or maybe like any strategic investment, so all those judgments you need to critically evaluate and understand from both parties, like how you're gonna achieve those, right? That's the reason, like before the acquisition, generally acquirer do the due diligence, right? Have you heard about due diligence? Have you guys heard about due diligence? What is that? Are you guys with me? Hello?
Yes, sir, we are with you.
Yes, sir.
So the first half of your question was where people would have answered, like, what have you heard about due diligence? Everybody would have said yes. But the second question that you asked, like what it is, nobody wanted to respond.
But I have not heard even yes.
No, so people were going to say that, but the moment they heard your second part of the question, they were like, okay, we cannot.
So you are saying yes in mute, huh?
Yes.
I know that.
Okay, have you heard about due diligence? Like,
Yes.
have you guys heard about due diligence? Generally, like when you do any acquisition, merger, like acquiring company or merged company, they do due diligence, both financial as well as legal due diligence of the company to make sure like these all assumption for which I am acquiring that organization, because acquisition is generally based on future projection and the current position of the company, right? For the current position, you will get NRV, but for the future projection, you will get goodwill. Right? Makes sense?
So due diligence is primarily like all the checks and cautious steps that individual or company would be taking before they could get into that. Right?
So they drill down, on all each and every assumption that party has taken to make these financial projections.
Okay.
Right? So risk of material misstatement normally varies with the complexity and subjectivity associated with the process, availability and reliability of the relevant data, how the data is being relevant, what all assumptions you are taking, how much subjectivity is involved in that, and how complex that calculation is. That is one thing you need to keep in mind. Second is how much reliable data, because the data which I have taken, which I have shown you, is for startup, right? So purely all are assumption based number. There's no history to it. But when to any existing company somebody is acquiring, so there is some history to it, like your month-on-month revenue, your month-on-month cash burn rate, your month-on-month or period-over-period growth rate. So there is some history to it, and then there are certain assumption for the next couple of year projections. So there you need to test the availability of the reliable data, which has considered as a base, and then on that base they have built on. Significant assumption they have taken and degree of uncertainty in those assumptions. So now coming to the procedure part. As an auditor, for example, if you're doing audit of a company like Google, who do like more than 200 acquisition every year, almost. Like Intel, if you've seen, like on an average, they do 20 to 25 acquisition every year, right? Same way, like many companies, especially in technology sector, they do huge number of acquisition. So you might be testing those acquisition. How do you test those? right? So keep this procedure in your mind. It will help you in doing those audit. First is auditor objective is to obtain sufficient and appropriate audit evidence about whether the accounting estimate, including fair value estimate in the financial statement and related disclosure are adequate. First of all, you need to look at the available audit evidence to test those assumptions and ensure those evidence are appropriate and genuine. Second is auditor should obtain an understanding of applicable reporting framework. So here reporting framework also matter most, because like fair value estimation as per US GAAP might be slightly different than fair value estimation as per IFRS. So here you should have an understanding of the financial reporting framework in which you are working on. How management identify those transactions and events and condition that may give rise to accounting estimate. So how management, for example, let's say provision for leave encashment or provision for gratuity or long-term employment benefit. How management has identified that this much amount I need to pay to those individuals. So for example, like in employee category, you will see two category of employee. One is white collar and one is blue collar. Have you heard about this term before? Blue collar employee.
Yes, sir.
So are we white collar or blue collars?
White collar, sir.
Really, we call us white collar.
Huh?
Color.
Sorry?
Then we technically we call us white collar, but sometimes we feel like we are blue collar only.
No.
Right.
Blue collar people get salary or compensation for each hour they spend.
तो सर हमारा भी तो टाइम शीट है ना.
But what you spend for overtime, you don't get. They get 1.5 times of their normal charges for the overtime.
यही gossip हो रहा था.
मतलब ये हक मानना
लेबर लॉ के
पड़ेगा.
पास जाओ.
Huh?
यही होता है सर, gossip होती है कि लेबर लॉ पे जाते हैं, बात करते हैं.
Not labor law is not applicable for the white collars. Unfortunately and unfortunately, we all fit into white collar category. So we cannot ask our employer, I can do extra work, but if you pay me 1.5 times. No, we can't. But for blue collar, they charge 1.5 times minimum. They can take more, an employer can give more, but at least as per labor law, they need to get 1.5 times, 1.5 times. So coming to the estimation point. So there are two kind of estimation. One is for the blue collar employee, that maybe you can take, generally they have union agreements for the blue collar, right? Which is 2-year, 3-year or 5-year agreement in which all the terms and long-term employee benefit are being clearly mentioned, right? And for white collar, it may be as per the company policy and it has to be given in your employment letter, right? From there, you can validate those assumptions or like how the management has identified the respective data. Now the data include like payroll register and the you can say employee master data as well, right? In which, what is employee master data? Any idea what is employee master data?
A master file that includes all the information related to an employee, their joining date, their all the social securities, what their pay would be, everything.
Yeah, absolutely true. So employee master data is the data which is, you can say, a permanent database of the organization for their individual employee, which include their name, address, phone number, email ID, qualification, previous experience, and currently in which service line you are working, what is your joining, date of joining, and what is your date of birth, so on and so forth, right? So all those information that actually they give to the actuarial, and same you are validating. So this is like third point over here, how the management make estimate and the data on which they are being based. The next is method used by management in making the estimate. Like for example, for actuarial valuation, they are using Black-Scholes model, right? For inventory valuation, they might be using FIFO method, LIFO method, weighted average method. So which method actually they are using? Is that method is acceptable as per the accounting framework or not? Relevant management controls over the accounting estimate. That means, do the management have sufficient and appropriate internal control over the financial reporting framework relating to those areas which involve management estimate? For example, let's say inventory obsolescence provision. So how they identify the inventory which is being about to obsolete or it's obsolete? Whether they do physical count of the inventory, right? Who do the physical count and who do the review? Then how they mark those obsolete inventory physically identified to the rate list to calculate the value of obsolete inventory. Then who is making those calculations and who is reviewing those calculations? Who is parking the journal entry and who is approving the journal entry? Does they have all these controls over there or not? Right? Identifying whether the management used any specialist for like actuarial, valuer, management process of developing the assumption, how management develop the assumption. For example, provision for doubtful debt. So they take like 1% of the credit sales as the provision for doubtful debt. But how they have developed that 1% assumption? Right? Is it based on past historical data? Is it based on industry trend? Right? How exactly it is? That also you need to understand and validate. Next is change in the method of assumption from prior year. Like for example, in previous year, if the company is taking 1% of the credit sales as a provision for doubtful debt, and in current year they decided to keep it 0.5%. Why they have made that change? So you need to evaluate critically that, right? How management has assessed the effect of estimation uncertainty. So this is called sensitivity analysis. Have you heard about this term before? Sensitivity analysis?
Yes, sir.
Any idea what is
यही
that?
सर पूछना नहीं था मैंने क्या आंसर करा इस बार की मैंने कहा I heard it.
मैंने हिम्मत करके आंसर से किया और कोई तो बोल भी नहीं रहा है. Yes, Jasprit, Sanchit, Kush, any idea of sensitivity analysis? Nimisha?
नहीं सर, इसको नहीं
Sir,
सुना.
I've heard in the past, maybe I would have also seen. I mean, I just have a broad idea that sensitivity analysis is primarily like using various combinations, you try to achieve a certain output. So you kind of change the inputs in terms of what parameters you are putting, and then accordingly your output, what you're looking at is kind of changing. So
What I
might
know
be wrong.
from sensitivity analysis is like, as far as I remembered, I studied it in financial management during my CA final exams. When we were studying, when we study these market bonds and the government securities and all those, you know, so we actually compare what interest rate what is we are getting in comparison to what market is giving. That I think should be the sensitivity analysis.
Financial instruments की बात कर रहे हो?
No, not yeah, financial instruments we can say, like bonds and all. They would be financial instruments. They will be coming, right?
Yeah, that is one of the example.
Okay.
But from last couple of years, it's been mandatory to disclose the sensitivity analysis for the significant judgment area. So sensitivity analysis, for example, let's say provision for doubtful debt. You are saying you have taken an assumption like 1% of the credit sale would be your provision for doubtful debt. So if it is 1.2, then how much it will be impacting? And if it is 0.08, how much it will be impacting? Would those impact be material to the financial statement? That is something you need to analyze. Same way, like for example, let's say actuarial valuation for the long-term employee benefits. So they have taken like salary increment rate 10%. Based on that, they have done all the calculation. If salary increment go 12%, then what would be the value? And if salary increment go 8%, then what would be the value? So these kind of sensitivity analysis is being nowadays a mandatory disclosure for the estimation and significant judgment. Same way, like for example, warranty provision, right? If you have taken like 2% of your sales may come back for the warranty claims, and every claims will cost you, let's say, $100. Then you need to calculate that warranty provision based on the assumption and presumption you have taken. Now, here you need to do the sensitivity. Instead of 2%, if 1.5% claims come, then how much would be the value? And if it is 2.5 come, then how much it would be value? So that like user of the financial statement better understand the maximum possible risk around those estimates and judgment. So that is the intent and reason behind the sensitivity analysis that each organization need to disclose for their significant risk areas. Make sense?
Yes.
Judgmental area. So yeah. Third point is determine whether the management has appropriately applied the required applicable framework, that means US GAAP or IFRS. Next is evaluate competency of the management personnel involved and using the relevant reliable database. For example, the person who is taking estimation for provision for doubtful debt, obsolete inventory, warranty provision, long-term employment benefit provision, litigation claims and assessment provision, whether that person is competent or not. So that is also you need to evaluate. Right? Review prior period significant accounting estimate. So you also need to review prior year documentation and ensure the current year is consistent. But if there is not consistency, then you need to plan and perform additional audit procedure for that. Testing highly sensitivity assumption or assumption significantly affected by the judgment. So you need to test those significant assumptions. Evaluate whether the circumstances producing such a biased representation a risk of material misstatement due to fraud, right? So that is also you need to evaluate whether there is a management fraud involved in it, management overriding of control involved in it or not. So these all things you need to keep in mind when you are performing the test of accounting estimate, including fair value estimate, right? So first thing, the risk, what are the risk indicator? Second thing is what are audit procedure you need to plan and perform to mitigate those risks, right? So far so good. First point and second point.
Yes, sir.
Third is related party and related party transaction. So any idea what is related party?
Yes, sir.
Yes. What is related party?
So related party, yeah. So related party are basically the parties which are related to management, those charged with governance, close relations, like it can be family members or friends, or there is an investment of a holding company into a subsidiary company, and its director is the director on the board of that holding company as well. All such relations which can affect the genuinity of a particular transaction which is being conducted between these people. Those are related party transactions.
So associates, joint venture,
Yeah.
or subsidiary.
But
Immediate parent or ultimate parent.
Sorry.
Immediate parent company, ultimate parent and controlling party.
that would just be a part of that entire definition.
Yeah.
Yeah. That is from the corporate side of
Right.
But yeah, director, their relatives, their family member. Yes, absolutely true. Very good. Thanks, Ayush and Sanjay. So related parties consist of the following: affiliates. What is affiliates? Any idea? Sir, ये तो सोचा नहीं था.
Affiliates are basically entities which are operating independently, but they are somehow related to the parent to a particular company in certain class of transactions, or they are having a certain dealing. So they are affiliated to, maybe funding is being done or something like that. Affiliate.
Like very a small percentage of investment that we have done in it.
Maybe, yeah.
Yes.
Any more explanation?
Sir, I think we studied about this in regulation, or I don't remember.
Far,
But I
far,
think
far.
it was more about it's a subsidiary of a company which a subsidiary of a company which can you hear me?
Yes. I
Okay.
also think that
Acha.
it's a subsidiary of a company, right?
Yeah, wherein the parent is holding, I think, more than 20%, but
But
less
that's an
than
associate.
50%.
That's an associate, I suppose. But if
More than 20, but less than 50 is what I remember.
that's an associate, I suppose, as per the definitions and all that.
Yeah. And any more right, left, center view?
We are helping you. You
It
should not.
seems Kamal sir is having fun. Kamal sir is having fun. He's like, okay, you guys be.
Vineet, Kashish, Avneet, Nimisha, any thought? Related party, what is affiliates?
I have a disclaimer, guys. Don't answer. Sir is making fun of everyone.
No. Why not? Like, let's make it interactive. Huh? Don't force everything on me. Yeah? Okay, let's do a small exercise over here. Okay. So let's see. Can you see whiteboard?
Yes, sir.
Okay. So here, like this is company A. And it has made investment in, let's say, B 51%, C 20%, D, let's say, 10%. And then now this B has got a subsidiary for the, let's say, E Limited, in which B has made 80% and C has made 20%. Right. So in this case of scenario, A is like the parent company, which is having
Ultimate.
sorry, which is
A
having,
will be the ultimate, na?
yeah. So A is what? Parent company
Ultimate
for
parent company, right?
Holding company.
parent company for whom? B. Right? A is a parent company for B. Right? And what is the relation between A and C?
It's an associate.
It's an associate, right?
Yes, right.
And what is the relation between A and C? D, investment only. Right? Only investment, no associate. Right? Make sense?
Yes, sir.
Yes, sir.
And what is the relation between E and A?
AN?
That would be an affiliate, I suppose.
No, A and E.
A and E.
Ultimate parent company, sir.
Ultimate parent company,
Yes, sir.
UPC, right? And what is the relation between B and C?
They are affiliated.
Yes, this is affiliation. Make sense?
Generally, we see it as sister company or like so. Those are affiliates basically.
Yeah, in the same group, falling in the same group, right? But they do not have direct holdings in each other, right? But they are part of the same group. Make sense?
For an example, can we say BBK, Oppo, Vivo, OnePlus, and Vivo and Oppo are affiliates?
Say that Vivo and Oppo are affiliates, yes? Same way like
parent company and Oppo
yes,
and affiliates, right?
yes, same way like Reebok and Adidas, they're also like affiliates company. The group is same. Right? Make sense? So far, so good.
Yes, sir.
Very nice.
Interesting.
Yes.
Okay.
तो बच्चे जो 10% वाली थी मतलब डी, तो उसको भी हम और सिर्फ इन्वेस्टमेंट कंपनी बोलेंगे?
For main parent company, it is just an investment. If it is less than 20%, it is just an investment, fair value investment. So we'll do the valuation of that investment at fair value, right? But for B, C, and D, they all are affiliates to each other.
Okay.
Right? So now, first one is related party include affiliates. Second is equity method investment, in which like 20% investment has been made. Third is trust for the benefit of employee managed by the management. If there is any trust formed by the management for the benefit of employees and operate and governed by the management, then that trust is also a related party for the company. D is principal owner of immediate family. So, for example, here you can say directors and their immediate family member, right? Or shareholder and their immediate family member. Next is one party control or has significant influence over the management or financial and operating policies of other company. So that company is also called related party. For example, let's come back to the same example over here. So let's say here this D company have a subsidiary 80% investment they have made in company F, right? And in this F company, A company has no direct shareholding, right? They have indirect shareholding of how much percentage? 0.08, right? 0.8% only. Have you done the math? I think you all are on same page. 0.8%.
Yes, sir. 10% of it.
But this A company management have influence on the financial and operating decision. They take all financial and operating decision of this F company. So this F company is also come under the related party definition for A company. Make sense? Financial decision, like say they appoint their finance director. They appoint their managing director. They participate in their board of director meeting. Right? Make sense? Then this is the parent, this is come under the related party, even though they do not have direct shareholding in that company, or they do not have any significant shareholding in that company. Make sense?
So, sir, this related party piece, I mean, related party transactions are allowed, right? It is just that they have to be presented and disclosed.
No, they two things. They should be on arm's length and need to be disclosed in financial statement. Yes.
Okay.
No prohibition at all.
Okay.
So here we are understanding first what is related party, so that we will be in a position to assess the risk and plan the audit procedure accordingly. So far so good?
Yes, sir.
Yes, sir.
Okay. Cool. 1 second. Okay. So the E point, it says one party control or has a significant influence over the management or operating policy of other company, then that company is also come under the related party definition. F point is any other party that can significantly influence management on operating policies of the transacting party or have ownership interest in one of the transacting party is also called related party. That means where one third party can influence the transaction between the two party, and to those party they have influence over the operating policy or financial decision making, then that party is called related party to those transacting party. So these are like high level definition of related party, but for more detail, we'll be studying in FAR. I'm sure we all have, some of you have already studied FAR, but that accounting standard will come in FAR, which is for related party. But here, just high level from the audit standpoint of view, you should have understanding from the company. It may be affiliate, it may be subsidiary, it may be joint venture, or it may be, you can say, business associates, right? And then it can be a trust which is being managed and operated by the management of the organization. Now coming to the individual shareholder and director, the close family member of those director and shareholder comes under the related party definition, if I summarize everything in a very short form. Now you understand what is related party. Let's assess the risk and the requirements. First is disclosure of the related party transaction. It's being mandatory disclosure as per the ASC. Second is substance of a particular transaction may be significantly different from its form. So the risk is that the substance of transaction might be different than the form it is looking at. So have you heard about substance over form? Somewhere in your college days? Or maybe in any
Yes, sir, I have
law
heard.
lecture?
Yes, sir. Yes, sir.
सुना है but पता नहीं है उसका.
Okay.
Their substance over form में यही होता है basically कि the transaction is being presented in a particular way, but actually when we go into the details, dig deep into the details, the substance is actually something. Form is like the superficial picture that is being presented to everyone. Yeah, no, it's being wrapped up in a particular thing, and then what the actual matter is, that is totally different. So we should always check substance. What is the real thing behind that transaction, real motive and intention, rather than how is it being presented to management or the stakeholders and everyone.
Yeah, very good, very good. Sanchit, Kush, any idea? Nimisha, would you like to add anything? Havneet, Vineet, Kashish, any idea?
काफी कुछ सही बोल दिया.
But have you
बस
heard
मुझे
this term?
गाना याद आ रहा था ऐसा इसके लिए. मतलब मैंने जब ट्यूशन पढ़ी थी तो उनका ना काफी ऐसे इनोवेटिव वेज होते थे. तो कहते हैं कि चोली के पीछे क्या है. ऐसे याद रखना तो याद रहेगा तुम्हें. तो वही मुझे गाना याद आया.
बस रहने दो.
फिट बैठ रहा है यहाँ पे.
Leave it. Don't get into that. Yeah, okay. Anyone else would like to add? Vineet, Nimisha. Now, very good. Like especially in a law, interpretation of law, we'll always go on substance over form. Substance is what actually in real terms, and form is something which is presented to all over the world, right? So we need to look at substance over the form, same way in the related party transaction as well. So maybe there are some transactions which may looks like it's not related party, but actually they are with the related party. For example, let's say Kush and Ayush as a company, and Ayush is, let's say, is a relative of for example Vineet, and Vineet and let's say Kashish has another company, right? And now Vineet wants to make a bigger transaction with Ayush and Kush company, right? And how they make the transaction, they involve Sanchit as a broker in that transaction. So, for example, now Sanchit, maybe I can draw, otherwise you may lose the crux of the story. So let's say here. So let's say this company name is Kush and Ayush. Right? There's one company, Kush and Ayush, and there's one company who was the owner, Sanchit and Sanchit. No, Sanchit is broker. Vineet and Who is the owner of another company? Vineet and let's say Nimisha. So you two guys are owner of this company. So and Ayush and Vineet are, let's say, family member. Right? So what Ayush and Kush, they wants to make a deal with Vineet and Nimisha, but they are related parties upfront because of the family relation. So what they did, they involve a third party called Sanchit. So they said, Sanchit, we will purchase from you if you purchase the material from this company, right? So Vineet is doing purchases from, Sanchit is doing purchases from Vineet and Nimisha and company, let's say at $10, and he is selling to them, let's say at $10. This is just a pass-through entity. But in eye of law, it seems like we are doing this transaction and there is no related party. Yes or no?
Yes, sir.
Right? But you need to go in the substance over form. In substance, we are buying from this company. Right? So that is called substance over
Sure.
But so what if I sell it at $12 and give $2 as a discount, as invoicing? So then also it will be a substance over form? Because the exact transaction will be of $10 only. It's just
for example, like $10 is their purchase price and they load, let's say, $2, and that may be their administrative charges.
Yeah.
Right? Or a nominal profit. Then also it's substance over form. It's a related party transaction.
But sir, a question.
But I'm saying if I do a normal transaction, but I show my profit as discount in invoice.
Sorry, say that again.
Okay, like I purchased it for $10, and then I'm charging it at $12. And instead of $12, I'm saying that $2 is my discount.
So 12 minus 2, you are saying.
Yeah.
But are you selling to other customer or not?
You only to Kush and Ayush.
Sorry?
Only to Kush and Ayush.
Yeah. So then it's clearly says that it's a related party transaction because substance over form is you're buying from Vineet and Nimisha. Right? So those things you need to evaluate case by case. Yeah, there is a lot of permutation and combination possible. Yeah, Kush, you're saying something?
Sir, in these cases, is it through inquiries or how do you actually?
Sorry, you are on mute, Kush. Kush, I think you went on mute.
Yes, sir. I wasn't sure if I'm able. So my question is, like in this case, how do you actually identify that there was a third party that is kind of involved in who is a far distant relative of somebody? So is it through inquiries or what is the best way?
Yeah, very good point, Kush. Like practically, how do you get to know? So this is similar to like management overriding of control, where it is hard to detect upfront, right? But once you are doing audit, you might be doing inquiry procedure. You will be discussing not with the Ayush and Kush, but you will be discussing with their purchase manager, right? From where they are purchasing, how the arrangements are. You'll be looking at their agreement with the Sanchit. Like in that agreement, you may see they need to buy only from Vineet and Nimisha. Right. And then when you are verifying the document, there might be possibility like from Vineet and Nimisha, shipment is directly coming from their production house, their factory to your factory. Right. So those all corroborative things based on inquiry and inspection and observation, you'll get to know.
Okay, so it's primarily inquiries and what I could sense is
Or
mostly or audit procedures such as inspection of contracts.
Yeah.
Or
Combination of
observation.
all audit procedure, yes.
Okay, cool. Thank you.
Yeah, Sanchit, you are saying something?
No, sir.
Okay. All good, everyone? Substance over form?
Good, sir.
Okay, let me present it. Cool. So, third C point is assessing the risk of material misstatement, including whether the company has properly identified, accounted for, and disclosed the related party relationship and transaction within the related party. So this is also the risk you need to identify, whether the management is giving disclosure of all the related party and all the transaction with those related party, right? So this is all the risk assessment. An indicator of the risk are, for example, the company has given interest-free borrowing to anyone. So there might be an indicator that why they are giving interest-free loan to anyone. So there might be some related party possible, right? Selling real estate at a price that is different significantly from value. So in these days, you might have seen like this Rahul Gandhi and Sonia Gandhi case. Have you heard about this Emerald company, or which company is it? Like newspaper agency to which they have transferred.
National Herald.
National Herald, right? So they have sold the real estate property for like some lakh rupees for some crore value of property. So it seems like something fishy, right? So same way, like if any real estate has been sold by a company to any third party, which seems to be a third party but not at a market price, so there might be a possibility that it has been sold to the related party. Non-monitoring exchange or loan with no return terms, right? You have given a loan to an individual but there's no return terms. Lack of working capital with the organization, urgent need of improving the earnings, right? Optimistic earning forecast, dependency on the few product or customer, decline in the industry, excess capacity, significant litigation, obsolescence of technology. So these all are indicators basically for the risk indicator. Now coming, so first we have done identification of related party, right? Second, we have discussed the risk in the related party. Third, we have discussed the indicator which may result into the risk of related party, right? And now we are coming to the audit procedures need to be planned, performed to mitigate those risks in the related party and related party transaction. First is determine the existence of related party. How do you determine the existence of related party? Any idea? How do you identify the related parties at first?
So we can check whether the transaction is at arm's length price or not.
No, the question is how do you identify the related parties first? Transaction pe to, like you will reach after that, right? Once you, how do you identify? How do you know these are the related parties? This was the question when I joined PwC. It came in my interview back in 2008. How do you identify related parties? Yes, no, any idea? Auditors in the room.
Sir, what we can check is from the definitions जो भी requires उसमें law के हिसाब से whatever related parties are mentioned, we can check if any transaction has been done with those related parties.
No, I am still at first point.
Okay. Maybe through
How do you
inquiries.
identify the related parties?
Sir, when you have those meetings and conversations with the management to understand if they have had any transactions with the related parties or what related parties they have. So through inquiries and meetings and discussions.
And through pre-war financial statements.
Right. यही बोलने वाला था मैं ये अभी
Yes. Yeah, Nimisha, Kashish, Any
Almost
thought?
like an intercompany matrix which shows all the transactions between the parties within the company and within the affiliates and everything. That can be used to identify related party transactions.
Okay. What else?
Having a repetitive transaction from the same party or at the fair line price from the same party.
Yep. Yep. Anything more? Okay, I'll summarize for you. First and foremost important step is inquiry. You'll be doing inquiry with the management and inquiry with those charged with governance, right? Second thing, you'll be looking at shareholding pattern, right? Third thing, you'll be looking at directors, right? Fourth thing, you'll be looking at the organization structure, like which is parent company, affiliates, subsidiary, holdings. That organization structure you'll be asking to the management, right? Fourth, in context of US, have you heard about Form 8K? Have you heard about Form 8K?
Yes, sir.
What is that?
I mean, sir, specialized events. Sorry.
Yeah, Nimisha, you were saying something?
The form which is used to
Yes, sir.
file about the non-unusual events or some special events that occur in a company, such as कोई shares significant IPO issue or shares issue हुआ, तो उस type की information.
Right. So appointment of director, new shareholder.
If there is any change in director, and if there is any merger acquisition as well, so that.
Right. So we'll be looking at the Form 8 they have filed, right? And then what else? Minutes of the meetings, minutes of the board of director meeting, audit committee meetings, shareholder meetings, right? All those things you need to review, right? To identify the related party first. Then you will jump into the transaction side. Second is identification of transaction with related party. How do you identify the transaction with those related party? First, you have identified the related party, right? You did inquiry, you did discussion with the management, you look at shareholder minutes, you look at directors minutes, you look at audit committee minutes, you look at Form 8, you look at organization structure, and you look at previous year financial statement, everything you have done, and you have made a list, like these are the 20 related parties. Now, how do you identify the transaction with those related parties? Come on.
Sir, contract reviews.
Yeah. Whether we are making any purchase with those related party, which has been identified as the related party, sales of goods, services, right? We go to the sales register, purchase register, right? And journal ledgers to see all the
like journal entry testing and all when we do.
Yeah, right. So that's how you will be identifying the transaction with the related party. Third is examination. Examination you will be doing like contract review, invoicing, shipment, services providing. Same way, like how do you test any purchase or sales or services transaction, right? And then you need to evaluate whether those transactions are on arm's length basis or not. Lastly, requirement is disclosure. Disclosure of relationship. That means who is your parent company, who is subsidiary, who is affiliates, who is joint venture, who is director, who is shareholder, right? So those nature of relationship you need to disclose. Description of transaction, like from where you made purchases, sales, receivable, payable, loans, borrowings, any such transaction, you need to give the description of the transaction you have made. And value of transaction, what is debited, what is credited, and more importantly, what is balance due to or receivable from that individual related party. So these all are the disclosure requirements. Once the auditor find undisclosed related party, he should perform the additional procedure. So here, like for example, company has not disclosed that arrangement which we were discussing. So they were saying like all the purchases they are making from Sanchit, not from not from Vineet and Nimisha, right? And you, when you are performing as a smart auditor and you identify you are making a fool, right? So you are doing a transaction with your brother Vineet, right? And you are not disclosing those transactions in a related party disclosure, then what all additional procedure as a CPA we should be performed for the Ayush and Kush company? First, like inquiry with the management to understand why they have not disclosed and what is the reason for not disclosing that related party. Evaluate why the discovery was not disclosed. Communicate the disclosing item of management and appropriate engagement team member. Assess the need of additional audit procedure like assessment of internal control, reassessment of the risk of material misstatement, evaluation of the implication on audit. If non-disclosure indicate fraud or non-compliance, then accordingly dealing with it, right? And then evaluate the relationship and transaction and communicate to the audit committee. If the statement contains a representation that is unsubstantial, that is not on arm length basis with regard to the related party transaction, the auditor should qualify or adverse the opinion. If the transaction with the related party are not on arm's length basis, it can be a good basis for the qualification or adverse opinion, right? Makes sense?
Yes, sir.
Hmm.
So a
Yes.
question, in cases of related party, is materiality a factor that only material transactions need to be disclosed for related party or all the transactions?
Yes, yes. No, materiality
Is
will
a
be
factor.
considered. Yes.
Okay.
Right. So we are done with three things: compliance with law and regulation, accounting estimate, and related party. Maybe we can take a break over here and then we'll cover rest of the three topics.